Hello, everyone, and welcome. On behalf of CEPR and the World Intellectual Property Organization, I'm very happy to moderate this incredible panel on two reports called Where Music Meets Finance. I'm particularly excited because this is bringing together the two biggest loves in my life, taking away individuals, of course, which is economics and music. So I'm very excited by the discussion that is going to ensue. The reports are saying, as you will see in a moment from the authors, that music has moved from being a cultural product to becoming a recognized financial asset class. And this transformation raises important economic and policy questions. We are seeing not just higher valuations, according to the authors of the reports, but also a reorganization on who owns music, who bears risks, and how returns are distributed over time. And in my view, this highlights an important potential tensions, since music IP has become attractive to investors, but the question is about incentives for future creativity, for the sustainability of the creativity in the music industry. You will hear from the authors of the two reports. I will just introduce the panel very, very quickly. We will have first Dennis Colopy and Christian Peukert, academics who've been working in this area for a long time. They've been co-authoring the two main reports. I'll put, or maybe CEPR can put a link for everybody, since the reports are available for everybody to read. So there are the two main presentations, about 15, 20 minutes each. And then Martin Kretschmer will discuss more on the IP perspective. And Audu Maikori, who's a creator himself, he will bring an industry perspective. Audu is based in Nigeria. Finally, last but not least, Carsten Fink, who's the chief economist of the World Intellectual Property Organization, will conclude and will reflect on the policy implications of these two reports. Everything is being recorded, and I'm just flagging if anybody in the audience has a question. There is in the bar the Q&A section for that, and I'll be collecting possible questions which I can then deliver to the authors and the other speakers. Without further ado, I will now ask Dennis Colopy to start with his own presentation, and that he is going to share with us the presentation.
Thank you. Hopefully that's going to share. Okay, it's already gone back. On slide. Yeah, so our presentation between Christian and I is in two parts, reflecting the two different reports that were commissioned by WIPO early on in 2025. So the first one is by myself on music rights and alternative assets, and that's based on a report co-written by Professor Peter Schmuck, Christian Hanke, and myself. And following my presentation, obviously Christian will give you a more detailed overview on IP finance in the music industry. So we need to go next. How am I doing here? So let me just move this. So the key market players in investment models we found, obviously, the major financial institutions were BlackRock, Blackstone, Apollo, KKR, Brookfield, and Carlyle. And they generally partnered with specialized music IPR firms such as Hipgnosis, Primary Wave, Harborview, Litmus Music, and Concord. And the notable example we draw attention to in our report is Shamrock Capital, which had a direct acquisition model. An example given, which we'll talk about perhaps later on also, was the purchase of Taylor Swift's early masters, $405 million. Sorry, just... Next. So we asked why music rights attract investors, and there are five kind of key reasons here. The durable cash flows, That's something that perhaps everyone in the music industry is are very much aware of, recurring revenues, particularly from streaming, more latterly, but traditionally broadcasting, synchronization, and performance rights. Notably, we found that the low correlation um, with traditional asset classes, and that enabled a greater degree of risk hedging. At the time of most of the activity, I would say when this became such a big phenomenon, the market conditions were very favorable, including low interest rates, and that drove the search for alternative yields. There's also the issue of cultural longevity. Heritage catalogs are generally insulated from short-lived musical trends. In other words, they've got established earning patterns. We also looked at efficiency gains, where the improved licensing, particularly data analytics, have really led to greater extraction of value and enhanced that. Through our interviews, we also try to establish why creators actually sell their rights. I mean, some of this is obviously based on the literature review, but the interviews revealed some very interesting concerns, perhaps, about why people actually sell. The number one reason, perhaps, was estate planning, converting catalogs into easily divisible financial assets. And that came from the literature review. But also professionalization. We expecting buyers to better monetize catalogs. This was particularly true of a certain class of creators who perhaps were sitting on their rights that were relatively underexploited at the time. Certainly, with the American creators, there were very significant tax incentives at the time of a lot of these very large-scale transactions with very favorable capital gains treatment. The liquidity issue was clearly a big thing here, financing large purchases or resolving legal disputes. That came into play with a couple of the interviews where there was animosity perhaps among band members who actually, which could only in fact be resolved through selling off the IP rights. And market timing was a key thing is capitalizing on the high valuations and strong investor demand. This is particularly true the time of perhaps the height of interest in this particular area, where there was a perception that this was a lot of money was available suddenly for people who perhaps had not really seen a great value in their catalogs. They were just relying on very steady, stable cash flows. I wanted to actually capitalize on that. How the rights were valued generally is royalty stream developments, performs across formats and platforms. This really has come to its own in the era of streaming, where it, for the first time possibly, creators and not and outside investors are actually able to see the performance of very significant catalogs. It's all there in plain sight. There's also the market demand and cultural longevity. What streaming has also produced is a skew, perhaps, in the way in which music is actually being consumed, with a heavy emphasis on the heritage catalogs. Catalogs going back 50, 60 years are suddenly coming back into demand. Streaming services and sync opportunities and emerging other opportunities through technology have also offered greater opportunities. The one issue I think we really wish we could have spent a lot more time on, but was the idea of rights bundling. This is one of the real innovations, because traditionally, even when music publishing and say master recording rights are held by the same parent company, they would actually be subject to very different contracts and contractual structures. But here we've seen the emergence of rights in the kind of bundled with both the composition, the master recording, synchronization rights, but increasingly name and likeness. This is very new. We also recognize the regulatory environment. where obviously there are competition law issues and AI training copyright issues as emerging as a potential, I wouldn't describe it as a threat, but as a danger, certainly for some of the catalogs. The We weren't able to actually put a number on the fractional investment places, but the securitization of rights, the number we've come up to, and this is to the end of 2024. So this figure does not necessarily reflect the state of play at the present time, but $6.2 billion worth of assets were securitized. But as we've recognized, there's a dual market structure with institutional investors almost always acquiring entire catalogs. It's not always the case that they buy an entire catalog. Certain examples with KKR and Teddy Reader, for example, and Johnny McDade from Snow Patrol, where they sold parts of their catalog over in different tranches. But retail investors are generally accessing fractionalized income streams, expanding participation across all the investor classes. The opportunities for stakeholders, clearly there's market consolidation with lower transaction costs and increased efficiency in rights management. Greater liquidity with capital inflows. I beg your pardon, sorry, my telephone's just gone. Beg your pardon. Sorry, a phone call just came through. So there's greater liquidity, capital inflows supporting higher valuations for music assets. And that I think is a really important asset, a really important insight for this, is the amount of money available supported the higher valuations than we've ever seen for music assets. The enhanced transparency we saw with investors demanding very robust valuation models relying on data, which for the very first time is far more easily discerned by the external investors. The new financial innovation models, ABS and fractional rights, have expanded the range of investment opportunities. Obviously, for stakeholders, there's a risk diversification. And for the creators themselves, they're gaining financing alternatives that are offer really different ways of actually securing finance other than the traditional label and publisher model. We are very concerned about the kind of potential for structural risks and challenges. Reduced A&R investments. The emphasis clearly is over prioritizing proven catalogs over emerging talent. Market concentration, which we'll talk about perhaps later on, with horizontal integration could disadvantage smaller artists and rights holders, and vertical integration with investors engaged across the value chain. There certainly is a degree of regulatory uncertainty regarding AI training and competition law. And we have to recognize, given what's going on in the world of PE, the potential for market volatility and the risk of overvaluation and price bubbles. And the final concern, I think, is about creative vulnerability. And we saw this in a couple of the interviews where the information asymmetry may lead those selling to selling perhaps prematurely and certainly not maximizing the true value of what they actually own. I'm going to try and because of the time, I'm going to try and cut through this and just concentrate on the ones in bold on our key findings. Stream economy has stabilized cash flows. This is probably the most important insight, and is making catalogs more attractive and easier to invest in for the investors. Securitization has transformed music rights into divisible, flexible financial products, ABS. And generally, and again, this came from the interviews, there was a low correlation with macroeconomic trends, making music IPR ideal for portfolio diversification. But we should stress this, the investment boom coincided with an era of low interest rates, with bonds were generating very significant or significantly lower, if not minimal yields. We recognize also the key risks involving volatile musical trends, although these seem to have been evened out. But arts behavior might affect value of an investment, and that's clearly the case with Shamrock and the Taylor Swift Masters case. And whether or not there's volatility in streaming cash flow remains to be seen, but we're going to touch on the reason why that might still be the case. What we consider to be the key areas for policy attention is principally competition, enabling effective and consistent oversight, particularly regarding vertical integration, transparency rules, new revenue streams, establishing clear and reliable rules for emerging income sources such as AI royalties, and talent development, safeguarding investment in new talent and A&R activities to ensure industry sustainability. My final thoughts are really these. We must recognize that there are still issues that affect valuations. Metadata continues to plague the entire music industry supply chain, particularly cash flows, and directly affecting the viability of investments. The potential for further consolidation has been exemplified by, at the moment, it's still rumors. These are not concrete transactions, but there are apparent mergers and acquisition activity involving larger aggregated funds. So the idea that actually the private equity investors would be there for the long haul may be subject to question. We also need to consider the notion of horizontal shareholdings across the whole industry, including established and new music firms. And that's me, that done. Thank you. Okay, and there's my conclusion.
Thank you. Thank you very much. That was fascinating. I had a question lingering in my mind since I come from competition policy, and recently the European Commission just approved quite a large merger between Universal Music and Downtown Music. It would be good to know whether they run a standard analysis. Are they missing something in light of your report? But I'll leave it there. Maybe we can have some questions for later, because now I'm going to ask Christian to present his own report, in fact.
Thank you.
So thanks, everyone. Thanks for joining. Thanks for having me. I'm Christian Peukert. I'm happy to present the second report today, to which also Alex Kunz at WIPO contributed. I will show some evidence suggesting that music IP is increasingly treated like a financial asset, maybe not just as a creative product. We're going to combine multiple data sources, go from macro sort of news trends to public copyright filings, to venture funding, to micro-level transaction data. And in the end, if I still have time, I'll show you a simple asset pricing exercise just to illustrate the point a bit more. So after Dennis' fantastic introduction, I can basically skip the slide, which just says that, streaming is really the starting point that has stabilized music revenues relative to the old cycle of physical sales and downloads. And then this has opened up the possibility to see revenues essentially as a financial asset. And then here really what we want to do in this study is to provide a comprehensive data-driven way to look at multiple complementary sources in addition to the deep dive that you've just seen from Dennis and his team. So here's the roadmap for my talk. I'll move from macro to micro. We'll measure market trends. We'll use the US Copyright Office data on registration and recordation to proxy for rights transactions and IP-backed financing. And then we'll look at venture investments patterns from Crunchbase and go into finally into the micro level, the transaction level data from a couple of music investment marketplaces that you've already heard from Dennis. And then, as mentioned, I'll try to translate the microdata into asset pricing objects. Let's see if we get there. So we start with the discourse because it's perhaps often easiest and the earliest public signal that the market is forming. So what we did here was we collected 650,000 articles from 6 music industry outlets and then ran it through natural language processing models that helped us to isolate 2,000 articles that are actually about music IP finance. And then looked at the topics that were actually discussed in these publications to get some of a feeling for how IP financing in the music industry has evolved over time. And you see that there's a steep increasing trend in sort of the cumulative number of articles, but then there's also this sort of peak in 2001, the early 2020s, where the topic was discussed most in the trade literature. So what are the news actually about? So this slide shows you topic composition over time, and I think what matters is really the shift in the mix. You see topics like music investment and acquisitions, major catalog sales, rights securitization rising sharply. And in contrast, more traditional artist label agreement topics are comparatively flat. So this is really just to say that there's two topics that in this entire set of things that are related to finance in music are really number 9, which is streaming revenues and expansion, and number 1, which is music rights securitization. Again, sort of bringing home the point that also Dennis made, that streaming is really sort of one of the facilitators, it seems, for music becoming a financial asset. Now, moving on from the discourse to administrative data that maybe can capture legal and financial activity. So here we look at US Copyright Office data that spans 40 or more years. And first we look at copyright registrations, which are, by the way, not mandatory in the US, completely voluntary to register copyrighted works. And what you see in these two graphs here is that there's a steady increase related to sound recordings, but a steady decrease related to musical works, which is compositions. And then we go into recordations, which document legal transactions around those rights that are registered in the first place. So within recordations, you have security interests, which use as a proxy for IP-backed financing. But then there's also transfer and assignments, which we use as a proxy for catalog acquisition and ownership changes. And again, for sound recordings, you see sort of a steady increase for these two types, the security interest recordations, which are the ones with the red dots here, as well as for the asset and assignment recordations, which are with the orange dots. And the decreasing trend that we saw for musical works also continues for the recordations. So a couple more points, which I don't have in the slides, but in the paper, we also saw that the average age of works involved in these transactions actually increases. So we show that for security interest type transaction, titles are typically referenced several years after registration, and the age trend actually rises over time. And for transfer and assignments, the average work age becomes much higher, around decades, which again is consistent with this investor demand for tested legacy catalogs with predictable streams. And then the second thing that we also discussed in the paper is that rights are consolidating. Also nothing new, given what Dennis just told you. Joint recordations that bundle music works and sound recordings are more than double from below 10% to around 20% in more recent years. And I think that's consistent with investors seeking more integrated control and market structure that becomes more concentrated, maybe less fragmented. All right, so let me move on to another database that we looked at, which is investment patterns. Here we look at data from Crunchbase, which is like a large database that essentially tracks new ventures, startups, and we look at ventures that are in the music space or in the music rights space in particular. And so we see a key pattern that rights-focused ventures actually grow faster than broader music ventures. While they are fewer in number, they attract a disproportionate share of the disclosed funding, which you see on the right hand side here. Again, we see sort of a peak in maybe 2001, 2002, and this sort of the steep rise since 2018 or so. Now that we've sort of looked at these broader trends, we can start to ask who's actually investing in these types of ventures. And the answer is it's highly concentrated, and it's the same names that Dennis already mentioned. So you have Primary Wave, and there's essentially, they only have one investor. Essentially, the Hypnosis Songs Fund is not very transparent. So we know that it's essentially two investors, JP Morgan on the one hand side with a relatively small share, but then also another investor that is not disclosed on Crunchbase. And then for the rest of this like puzzle chart here, you can see some others, and I guess by the size of the different shapes, you can also see that this is fairly concentrated, this market. So now let me move on to music investment marketplaces. So these are essentially platforms where anyone can invest in music IP rights, which is different to these funds. For example, the Hypnosis Fund that we just looked at, because these platforms, these marketplaces, essentially enable direct transactions between rights holders and investors. And so there are a couple of those. Dennis also mentioned some of them. MusicCow is one of the bigger ones that started in South Korea, and I think now has also US operations, Royalty Exchange, Songwest, Jukebox, and so on. And so what we did there was we essentially collected the publicly available data from these platforms and tried to understand a little bit better what are the assets that are actually traded on these platforms, how are they priced, and so on. So if we look into this slide, you essentially see the growth curve of this marketplace segment. Together, these platforms, and I think it's at the time it was essentially all of the platforms, at least all of the platforms that had publicly available data. We see that they together offer an excess of about $45 million in annual royalty streams. Growth is really steep across the board, even though the shapes kind of differ. For example, Royalty Exchange grows more gradually over a long period, while Jukebox appears as a jump because it kind of listed all the assets at once in our observed data. So they apparently started with sort of an installed base. So the key point here really is not only the level of these 45 million, but that there's an emergent market with distinct institutional design, which really differs between these platforms. And I'll show you a little bit more on that in the next slide, where we sort of can have plotted essentially the royalty distributions across these different platforms. You see that MusicCow, for example, has a much lower average royalty, and also it's spread out much less. But then for the rest, you essentially see a familiar structure that cultural economics has highlighted across different markets, which is an extreme skew across all of these platforms. A small subset of high value assets essentially dominates the royalty income. So you have really this textbook power law pattern, which mirrors essentially what we know about music listening, charts, catalog value concentration, these kinds of things. And that has the following implication, which I think is important to keep in mind, that average returns are really not representative because of this skewed distribution. And so the portfolio construction, diversification, selection, and so on are going to matter a lot. So now I can go one step further and convert these transaction into kind of an implied pricing object. You can think of this as maybe discount rates. So here the idea is really simple. For an asset that has a price V and expected cash flows, we can use the discounted cash flows formula that pins down an implied discount rate R. And then here in the data set, we essentially have two cases. One where we observe the licensing horizons. And again, copyright is very long, so it's almost always very long, in the excess of 100 years. But if we don't observe explicitly the licensing horizon, then we just sort of use the perpetuity formula, which is R is just equal to C over V. I think it's a reasonable approximation, again, because copyright just has very long protection. So what do we see in this on this slide? Discount rates vary substantially across platforms. Songwest and Royalty Exchange show relatively broad distribution, which is maybe consistent with heterogeneous assets and maybe also more dispersed investor beliefs, whereas MusicCow really has a much tighter distribution, where maybe there's a more standardized deal structure. MusicCow is also the only platform that essentially works as a stock market for IP assets, where anyone can take part, which I guess also explains a bit why it appears to be a bit more standardized. It allows for high frequency trading in a sense. And then finally, Jukebox is extremely narrow, clustered very narrowly between 2.8 and 3.8%, which suggests an even more rigid pricing framework. So I think what we can take away from this is that there's lots of heterogeneity across these platforms. They're trying to position themselves on the market and differentiate. Now, finally, I'm going to zoom into one of those platforms, MusicCow. I already mentioned that they are essentially a stock market for music IP assets, and that allows us to essentially analyze high-frequency trading data and then estimate asset pricing model. I'm not a finance professor, so I really had to go back to my undergrad econ education to remember what the CEPR model is. So it's not going to be very fancy, but it's going to tell us a little bit about how can you think about music IP assets as a as compared to any other financial assets. So again, as I mentioned, this is going to be MusicCow data. So I'm estimating this CAPM model that essentially compares the volatility of these assets that are traded on MusicCow to the volatility of a stock market index in the same country. Remember, MusicCow is a platform that's based off South Korea, so it's going to be the Kospi index, and then the alphas and betas are going to be the standard parameters that tell you, how related an asset is to market risk. So here I found that the beta is about 0.074, which means that market exposure is really low. And alpha is positive and statistically significant. And then, you can play around a lot with this, put in different fixed effects, cluster the standard errors, and all of these shenanigans. In the end, I think the interpretation of this exercise is that, at least in this setting, which again is a very specific setting, music IP behaves like an alternative asset class with low correlation to the broader market. And small positive excess returns. So it looks like it's a great way to diversify your portfolio. But again, I should mention this, and I cannot mention this often enough. There's a big caveat that this, of course, only one platform, specific institutional environment. We saw that this platform looks different than all of the other platforms, but I still think might be a useful benchmark here. With that, I want to sort of summarize a bit what we saw, some key takeaways. First, music IP finance has undergone rapid financialization. We've seen this, it's being treated like an investable asset, not only the creative output, and I think I've showed you a couple of pieces of data that underlines this. Second, Because we looked at multiple data sources, not driven by a single data set, we looked at news, discourse, copyright filings, venture funding, marketplace activity, and all of them point in a similar direction. Thirdly, investors appear to prefer legacy works with more predictable cash flows, and data really suggests that there's consolidation of rights and more integrated ownership here. Even if I had to sort of take the extra step in looking at ventures that deal with music and music rights in particular, but I think that's one thing we can learn from this descriptive data analysis. And then fourth, market seems to be concentrated. A handful of firms and repeat investors dominate the institutional segment, although there are some new platforms that are trying to, let's say, democratize access to IP in the music sector. So finally, I think I've shown you a little bit of evidence that the risk-return profile looks distinctive: low market exposure, positive abnormal returns in this very simple CAPM exercise, which I think is consistent with diversification benefits and sort of maybe a rationale for why investors will look into this. Again, this is the empirical snapshot. Bigger picture question is, of course, what does this do to incentives, bargaining power, governance of music rights, and so on? But today I really wanted to focus on measurement and some stylized facts. With that, I thank you for your attention. Thanks a lot to WIPO for the opportunity to work on this study, as well as to CEPR for hosting today's meeting. I'll stop here and happy to take questions.
Amazing. Thank you so much, Christian. That was very interesting. And there is a lot of questions that I'm sure people will have as a follow-up to your results. I will ask now Martin. Martin Kretschmer is a leading scholar on copyright law from University of Glasgow. And I'll give you the floor to comment on what you've seen so far.
Well, thank you. So I see my contribution more as a start to the question and discussion session. And first, I need to recommend both sets of authors. They are, forensic and colorful and a good read. So I recommend, to dig into the detail, and in Dennis's team, you can find out about disagreements in bands and about inheritance and about changes to American tax codes. And in Christian and Alexander's paper, there is a lot of interesting detail also on the recordation data in the US Copyright Office. So we get a lot of details also on how digital assets really work, and that there's really not one way, that we have acquisition models, we've got markets, we've got share of royalties. So there a great variety how we might treat music as an asset. So at the core of what I'm going to say is really that there are two different agendas here in front of us. So one is really a finance agenda. How do we understand this trend towards financialization of music? So what is music as an asset? And that's essentially a finance question. Whether you come up with a new Black-Scholes model of asset pricing, whether you do something like Christian proposed at the end. So there's definitely something interesting going on here. But then in the context of WIPO here, what does it mean for copyright policy? So if this trend to financialization is happening in the form and the evidence is there, what does it mean for the incentive for music creation? What does it mean for the A&R function and investment? What does it mean for diversity? What does it mean for competition? So first on the finance side, but this probably goes across both of that. So firstly, how these assets are created. So in law, this is obviously highly complicated. So we've got, the three core music rights, which are compositions, the classic copyright. We've got the sound recordings, and the performance rights. But then we also got in some jurisdictions image rights, and then we have trademarks, and these interplay with each other in a very complex way. And so essentially these are creatures of law, which then lead to, within each of these rights, you have different exclusive rights which are suitable to be turned into assets. So then, in the classic copyright, there each jurisdiction numbers them differently, but you will have the reproduction right, the communication to the public right, under which then broadcasting falls. You've got public performances, you've got adaptation rights. So you've got a class of exclusive rights. Each of them can potentially lead to an income stream. And then these exclusive rights in law are turned into economic activities, which may be streaming, or there may be broadcasting, or there may be, playing in somewhere an instrument, or it may be synchronization, turning, some music into, into a movie. So we've got this really complex layer from the law to the exclusive rights, the substantive law to the exclusive rights to the economic activities, and then we create basically flows of money which are more or less predictable. So that in itself is not anything new. So we have already in the 1980s and 1990s essentially music publishing companies, there were no longer music publishers in the old sense. Music publishing as an activity was printing music and securing performances for the music. But they became already right management companies a long time ago. Essentially, they're attached to big recording labels and then a vehicle for channeling royalties, which are based on the composition. So that is already a function which has very little to do with making investment decisions and A&R and seeking exploitation and optimizing productivity. Essentially it's a subsidiary to a different economic activity, which was essentially recording music and finding markets for that. Okay, so you could call this already a financialization of music, but it doesn't turn up in your data because it's basically it's not synchronized, not syndicated or securitized, or there's no marketplace for it. This is essentially a classic firm which does rights management. So let's come back to that maybe. Later, whether is this trend to financialization, which you accurately empirically track as an increasing one in recent years, is that really in something new, or is it just a new form of financialization? Essentially, so that's still at the borderline between the finance theory and maybe copyright. So now we're moving broadly to what does it mean for copyright policy. So to say something very provocative, I think we have not many industries where competitive advantage relies on back catalogs. So if you own a back catalog, and that's been in the music industry for a standard for a very long time, the revenues you attract from some of them, by active exploitation, but many of them just by passively tracking use, it creates a cash flow which gives you a competitive advantage. And my hunch is that intellectual property rights, for those reasons, have a tendency to concentrate. So once they become tradable, once you create intangible assets which are tradable, they tend over time to concentrate in back catalogs. And again, that is, I think, a trend that is seen in some of the data we seen today. But again, is that something new, or is it just more of the same? So looking now at copyright policy. So is it a problem for us if music turns into financial assets of this type? I would say yes. So in blunt words, it's probably almost a form of rent seeking. I can't see any incentive to invest in create. I mean, it could well be that some of these new players find new and productive exploitation channels. You may find new synchronization opportunities, you find new adaptations, you may find new exploitation uses which are really more productive, and the money flows into activities which benefit society. But it could also just be basically rent seeking in the classic way. So no new wealth is created. Basically, we have a non-productive flow of money, and I think that is a problem. That is a problem, and I'm. It's obviously tricky to say this here in the context of but the core of it is that the intellectual property rights as exclusive rights are far too long. So they're far longer than is required. But the fact that they are so long makes them into the financial asset class, which then becomes attractive. And as again the evidence has shown from both of the papers, essentially those which are suitable for turning into financial asset are narrow. That's it's those who have predictable revenue flows already. So therefore, we have a trend towards essentially less diversity built into the financialization of music into assets. Okay, so on this provocative thought, I leave it. I will come back later in the discussion. I've got specific questions for both of them, but I think that's the provocation.
Excellent, Martin. Excellent. Before I give the floor to Christian and Dennis, who will reply to you, though, I would like to hear first from Audu Maikore, who we're very pleased to have today with us. Audu is a prominent lawyer, an entrepreneur. He's a founder of Chocolate City Group, which is one of Africa's most influential independent music companies. So he can really tell us his views from the ground. And I'm also interested to see how he looks these trends from the perspective of an emerging market where the catalogs are newer compared to some catalogs that we have in the Western world, and perhaps some institutions may be weaker. So I'd be interested really to have Audu's take on the reports that he has read. Thank you so much, Audu, to be with us.
Thanks, Tommaso. Thank you so much. I'd like to share my screen as well, if possible. Okay. Okay. Can you see my screen? Can you see it? Good. All right. So basically, thanks for the opportunity. Great conversations, and it's interesting to kind of hear the breakdown. I peer reviewed the report, and I did that from my lens as someone operating in an emerging market. And while the report itself definitely was thoroughly done, I mean, I checked the methodology and looked at the just basically what the report spoke about. I identified a few gaps in it. So the strengths obviously is the rigorous analysis, around securitization and music rights and documentation and also a study on South Korea. But some of the gaps that didn't quite translate into emerging markets were things like enforcement is not even. CMOs are fragile if they exist. Currency volatility is high. Capital markets are quite shallow, and just in terms of the cultural output is severely undervalued. So what I see is a translation gap. So it's not the quality of the analysis. I just think that in emerging markets, the modeling is a bit different. Discounted cash flow models, for example, assume that there's a stable royalty, in streams. The previous speaker talked about how streaming revenue has stabilized the markets and made it more investable asset class. In emerging markets, that is not the case. So it's a bit difficult to model those out. When you think about investor protections, you kind of assume that there's a predictable enforcement, but that enforcement depends on which country you're talking about. It is few and far between enforced. It's not well enforced. Then obviously there's the issue of institutional maturity. You made the point about the age of our copyright works themselves. And then, of course, competition metrics. So, what does not always hold, for example, we talked about is uneven copyright enforcement. Different countries, different copyright laws, and different mechanisms for enforcement where they exist. The collecting societies, for example, Nigeria, for example, which is one of the biggest in terms of output of music on the continent today, barely has a functioning CMO. And the CMO doesn't have the right bilaterals with other collecting societies around the world. So you find then that you cannot get the data. And then, of course, that means that the catalog itself is greatly undervalued. We don't have great deep pockets here. BlackRock and the Hypnosis and co have raised billions of dollars. Trust me, a $1 to $5 million transaction here is significant. And then, of course, the money rails are not quite where they are. The credit system is wonky. It's not as developed as the UK and the US. So therefore, you cannot, most of the transactions here are really heavily cash based. And of course, the cultural power is still not there. So the result is that you now have no clear valuation models. You find that even when IP is registered, when your song is registered in Africa, it has no meaning whatsoever. It has no protection under the US law. So unless your work is registered in the US and the UK, then it probably doesn't exist. I think the South Korean example was quite interesting for me. And I think one of the reasons why it worked was clearly there's the regulatory powers there. There's rule of law. There's a high digital payment system that works effectively there. And of course, OECD level institutions. But if this was denominated in rupees or lira or cedis, I'm not sure if it would be the same thing. So I think it's talking about the dynamics. Now, if you look at a country like India, for example, it's film-anchored IP ecosystems and their right ownership's complexities. If you look at Brazil, there are multiple CMOs, and then the transparency of that is a bit challenging. Indonesia, there's low credit card penetration, and it's usually bundled with the telcos. Nigeria, it's a diaspora-weighted streaming system. So I'll give you an example. A Nigerian or African stream is worth probably 30–40% less than a US or UK stream. So you could stream the billions, but it really translates to less money because most of that is still anchored primarily in the more sophisticated markets. Just for brevity, I'll move along and I can share this deck later on if anyone is interested. But I think the critical reality for us in emerging markets is that you're not selling any catalog for any real tax planning or wealth diversification. It's mostly a survival mechanism. You need money right now, and someone's ready to pay a highly devalued amount for what you've created. And it's just basically like a bird in hand decision. It's not driven by any long-term investment play. And you'll find that the appetite for risk, especially in this emerging asset class in emerging markets, is very, very low. One of the biggest transactions that's happened, actually the biggest transaction in music that's happened in terms of any kind of that involved catalog was the acquisition of Maven by Universal. And this was completed in 2024, which is a landmark deal. But the truth is, if you look at sort of the metrics in the realm of what obtains currently, we're talking about a catalog size, maybe 2,000–3,000 songs, and some really big hits. It is not, what it should be ideally. So if you look at the infrastructure map, you look at how the systems aren't really quite the same. So if you look at reliable data, CMOs, very strong. We basically do not have any strong CMOs. I'll be surprised that what a CMO is collecting in a year is probably what a European CMO is collecting in a month. So it's significantly low. We do not have long-term data. You talked about newer catalogs, and if the average size of the catalog is 40, 50 years, then definitely what you're talking about is less than 10–20 years. So they're not really old catalogs per se. On the flip side, a lot of the Afrobeats and emerging music now is doing a lot of streams. They're doing hundreds of 3, 4, 8, 10 billion streams. So that might make up, but it's still not, it's a very small selection of artists that have that Enforceability of copyrights are very weak. The systems are weak and they're not well structured. And what you have at the end of the day is that you have definitely a more bankable asset if you're dealing with a catalog from the most sophisticated markets. And what we have is a devaluation of close to 50, 60%. Then there's the issue around financing, for example. Banks cannot lend without, the valuation itself. Investors are, the price, there's a heavy premium on and if you access any funding at all. And what we've seen over the past 25, 30 years is that there's a strong correlation between, the enforcement and protection of copyrights and the GDP of a nation. So you see that in emerging markets like Kenya and et cetera, it's less than 1.3%. While of the GDP, I mean, and while more emerging market and more sophisticated markets have higher numbers. I'll scan through all this. But I'll also say that in terms of the motivations for selling, primarily in developed markets is around taxes, rebalancing, planning, investments. Here is liquidity, it's survival, it's debt servicing, and just basically kind of surviving. So we have different views clearly based on the economic realities of the same business that we operate. So let me move to solutions. What we think is that there needs to be some sort of standardized valuation metrics, and I think WIPO could play a significant role in that. How do we level the playing field and bring more sophisticated, shall I say, expertise that helps kind of narrow that gap? Where's the equity if we have a lot of volume, but there isn't a lot of value in that volume? And obviously, when you think about, income method, so the market method as well, when you compare the transactions, clearly, we're highly, highly devalued. And then I'll also talk about being able to collateralize tools. So you walk into an average bank, no one's going to take your IP or your catalog or your streaming revenue for that. I was recently in a conversation with one of the institutional banks that's got the lowest interest rate in the country. And they said they do not take more than 20, 30% as collateral for any financing. You need to bring a physical asset of some sort or a bank guarantee for you to be able to access that. That's the challenge. And the reason was that there's a dearth of information as to why this is now a true asset class, because at the end of the day, in the local arena, it doesn't have the same impact as more sophisticated markets. CMOs are a huge problem, and they need a lot of help in terms of talent, technology, and just capacity, generally speaking. And so we think that we need to kind of digitize more the metadata and build more local distribution systems as well. I think there's an issue around simultaneous registration. I'm not sure this is the right platform for this, but I think that these are issues that we need to kind of think about. How do we sync this up so that it is not that expensive to register a copyright in these markets? I mean, IP registration is a must, but how accessible it is to the average creator is very doubtful, especially someone from the emerging markets. The other things around API integration, just looking at sort of how you can balance commercial interest and public interest and cultural legacy. So how can this report be enhanced a bit? And I think I touched on that a bit sorry, I missed that. No, I think I missed it, yeah. So I think in terms of how we can help, I think there's the capacity building, I talked about that. Valuation toolkits, for example, for banks and DFIs. How exactly can we create something that is local, but can be translated globally as well? And then looking at partnership models, what's the PPP model that can help in, say, copyright enhancement, enforcement, and modernization? In Nigeria, recently passed a new Copyright Act, is about 3 years old. And what they've kind of done is try to update it. But the last time that act was passed and was updated was 1988. And that was the original legislation. So you can see the gap and the lag and how much has changed between then and now. Then I think that there's also the issue of the cross-border registration infrastructure. I think that is really critical. It can do a lot in helping us, kind of figure out how to get our copyright protected globally and also reciprocate that on the continent. So I think this is the opportunity. WIPO does have the convening authority, and some of the players here definitely have deep networks, probably deep pockets, and definitely deep insight in that. So just to wrap up, I think it's just really around let's get the infrastructure fixed. Let's see how we can create better enforcement across the local institutions here. I mean, even a union of CMOs across Africa can help to kind of standardize and create regional packs that make transactions easier. And I think that even with the report, and I think finally, the final point I just want to make about the report is that I think that report is with all due respect, a phase one. I think we can have a phase two that focuses on emerging markets in a deeper way, or we can create another chapter that actually adds to that report to make it more robust. But otherwise, great work, and thank you for the opportunity.
Amazing. Thank you so much, Audu. And if there is a phase two, I'll be delighted if CEPR and WIPO will host it again. And we would be also so honored to have you again on this platform. Thank you very much. We had also some questions online. First of all, your presentation, Audu, was very well received. Somebody will contact you directly to have the deck of slides because they love them. And there is also Winnet who's asking about a set of metrics that investors or fund can using when pricing NIL assets, when NIL stands for name, image, and likeness. Now we have about 15 minutes to go. And there will be Carsten at the end to wrap up and tell us their perspective from WIPO. But first, I want to go back to the original authors. They heard a lot of comments and suggestions. Perhaps we do it in reverse order. I'll start with Christian first, followed by Martin, if you can react to some of the points you heard. So why don't you go first, Christian?
So thanks everyone for the very interesting insights. Audit was very fascinating to hear your perspective of the. I mean, you've already given us quite some extensive comments for in the first round, but it's really nice. So the combination of the two discussions I found very interesting because in a sense, Audu made a similar point that Martin, just using very different words and very different setting. At least sort of that's the connection that I made immediately. Martin's point was mostly about some of the concentration tendencies that we see are born out of the institutions that exist, versus Audu said, if the institutions are not there, then sort of all the securitization financing of IP assets cannot work, and I thought that was fascinating to hear these very different perspectives, but at the same time they came to a similar point, because initially I had written down as my response, and by the way I agree with everything that Martin said. My reply would be sort of even if this is all just leading to more concentration, and sort of it also naturally baked into how copyright as an institution works, maybe these democratization trends with the marketplaces that we see can actually be a way to front load money for artists, without having gatekeepers, professionalized companies that have maybe a different agenda. Martin called it rent seeking, and sort of more provide quicker access to capital, which is I think also what Audu said sort of is lacking, and I mean, this is way above my pay grade, but maybe something we can learn from the two results and sort of the state of how these things work as of now and in the Western world, is maybe there's a way to sort of leapfrog legacy institutions if they don't exist, and then sort of make IP financing sort of a financing of the kind that sort of enables cultural production where there's not enough investment to do so, or where the investment is too risky for individual creators. So that's my takeaway. I realize that I don't really answer any questions. It's much more fun to sort of keep thinking along those lines rather than trying to be too responsive to individual things. Thanks.
Thank you, Christian. Just something to think about. You said that maybe there is a different kind of democratization with the potential to front loading money for artists. I don't see how this squares though with the shift towards older catalogs. I mean, this seems to be a little bit in contradiction with each other. But anyway, I want to go now to Dennis, and you can react to the many questions, too many questions and points that have been asked, but too many just because it's so interesting what you are doing in the report.
Yeah, with that, thank you for Martin and Ali's different perspectives. They're really useful. I wish we'd actually interviewed how to for some of the emerging markets aspect, which was very challenging for us because we did ask the question, but it became apparent that the focus of most of the investments is on Anglo-American repertoire. That's not surprising, is it? Because it's success on the global markets. I don't say that as someone who supports that notion, but that seems to be the pattern that emerged. It then led us into asking a question which we never got the answer to, but it's something for hopefully there will be a phase 2 to this, Alexander, at one stage. Is the rights system that we have in Anglo-American, well, in the US and say UK, for example, more conducive to investment than say other markets? And I'm kind of turning what Ali was arguing is that it's the lack of infrastructure. Is it the very infrastructure, the legal certainty that you have from the investment that actually attracts the investors? And coming back to Martin's point, which I take as music as an asset. One of the interviewees said something which has stayed with me to this day, and it's a really important thing. The difference between the investors and the music industry is they treat these investments as quasi-mortgages. So their investment horizon and window is very different to that of the traditional music industry, which might be just about the investment window might be, I don't know, 18 months, it might be 3 years, it might be 5 years, even 10 years. But it's not going to be as long as the mortgage. And this is someone who played a big part in developing these kind of investment strategies about changing the nature of music as it becomes a mortgage, so it becomes more like a physical property, is radical. Well, for me, it was game changing, that particular insight. I also, and I think this is a really important point you make, Martin, about back catalogue dominating. This is extraordinary. And I think this has a lot to do with how the economics of the music industry have been transformed by streaming. Not downloading, not piracy, but by streaming, because suddenly you have access to the entire world's repertoire. That didn't used to happen. If you think back to the physical world, records were deleted. Radio stations had playlists and they reflected the release patterns of the record industry. So, and I think that's transformational now. So whether that inhibits or justifies the length of term is another matter. But I take your point about for asking the question. But we cannot underestimate the profound transformation that streaming has had in terms of the ability for people to access everything there. And consumer behavior is showing that people want to listen to old stuff. It's crazy. And that is what the investors are buying into. Going back to Ali's thing about the fragile collection societies point, which I really take on board. I think it's a really important issue. And I think Africa needs to kind of perhaps learn the lesson from Europe about maybe they should be an African collection society as a kind of umbrella and actually look at the issues that affect Africa, maybe led by South Africa, which because Samro seems to have one of the more developed kind of infrastructures and develop something that is pan-African, because the opportunity for African music, I think, in the next decade is immense. I mean, we're seeing the rise of Afro beats. We're seeing, and there really will be revenues that are potentially being generated for African repertoire, but the infrastructure is just not there to support it. And when we interviewed one of the investment funds, and we asked about the difference between Anglo-American repertoire and emerging markets. And the only answer we got was in relation to Korea. And it said that the rights system in Korea lent itself to catalog acquisition or company acquisitions rather than catalog acquisitions. In other words, it was easier to buy the company rather than buying the repertoire direct from the creator. And that's as far as we got. But I think we ran out of time. I mean, literally the scale of what we were asked to do, and particularly Martin's amazing work is kind of literature review, and he'd been working on it for 2, 3 years. Frankly, I think that there's another 2, 3 years project to really drill down and get this right, because what is shown is that we've only come up with part of the answers. I don't think for a minute that we've come up with all the answers. And I'm fascinated by it because I think that the direction of travel is positive, but I think it requires further investment. I really do. I think it requires further work. And I think the African model is perhaps something I would personally like to think of. And we know, and I think that he may even be on the call with us, someone in Norway is running, they run a round table, and they're planning to host an Africa round table this year. And actually, that would be the kind of appropriate kind of vehicle for that. And I know WIPO actually supported the last one in Norway. And I think maybe getting that kind of infrastructure so people can talk on a pan-country or pan-continental level would be conducive. Anyway, that's it. Sorry, I spoke too long.
Thank you. That's perfect. Thank you, Dennis. And now, obviously, WIPO has been mentioned a lot of times. So I'm gonna ask Carsten Fink, who is the chief economist of the World Intellectual Property Organization, to offer, his concluding reflections on this fascinating webinar.
Thank you, Tommaso. And the first thing I should do is to really thank the authors. I don't think I need to name them because they have all presented and you know who they are for having performed all this research, which from our viewpoint has been really fascinating. I should maybe at the outset mention at the genesis of this, and this was actually initiated not by us, the economists in WIPO. We have colleagues, not sure if they're on the call, Alison Mudges and Michael Koss, who really are responsible for IP-backed finance in the organization. And, they approached us and said, hey, this is a really interesting topic. Why don't we look at this deeper? In my own perspective, I had read about quite a few of the deals, especially I think the Financial Times had covered quite a few of the deals that have taken place, let's say, between the period from 2018 to 2023. And obviously, we had a lot of anecdotal evidence, and I think the one basic idea of the research was to go beyond the anecdotal evidence and to more systemically collect data and see how big is this phenomenon and what characterizes it, what motivates these deals. And despite all the unanswered questions, I would say that with the research that was done, we have made a substantial step forward in having better data, better understanding of this phenomenon. And in that respect, while I especially appreciate maybe Audu's dissatisfaction that a lot of questions, especially as it pertains to emerging markets, are probably not answered by the report. I would still hope that this is a very useful contribution. What is my own takeaway? And I realize we're running out of time. And I think one of the interesting questions that I've asked myself, when one looks at the trends that I think especially Christian presented, obviously a lot of these deals were driven during the COVID era by the low interest rate environment. And if I look at the charts that he presented, it looks quite similar to the charts that we have on IP filings, patent filings, trademark filings, where during the COVID years, there was really sort of a boom. And I think these were extraordinary entrepreneurial times. For a number of reasons, there were a lot of structural shifts, and of course, the low interest rate environment was maybe the tap that was open in terms of the finance that was available. And the question, and I think, we are asking ourselves that question also in other areas when it comes to venture capital investment. Was that a bubble that has collapsed, or is it something that's more durable? And in the case of venture capital, I think a lot of venture capital flows actually have dried up, except in the AI space. What I take away from the music study, though, is that it's not only in a sense, this low interest rate environment, that was behind the phenomenon. I think there were also more, structural shifts. So in particular, the shift in business models towards streaming and, the whole sort of technology that comes with it. And I think also, and I think this is of course really important in financial market, I would just say the better information flows that comes in this digitized environment that make it much more easy to value music and to engage in predictions of what future income streams might look like. And I think that is here to stay. I think the question is, and I think Christian didn't really go into that, but the report goes into that, is how does that change incentives? At one level you could argue, well, at the level of the really successful catalogs, there's a lot of money shifting hands, and maybe there's risk for long term. And that's probably a good thing. That's what financial markets are supposed to do. But what does it do to incentives to create music? What does it do really to the average artist, who sort of struggles to get attention and to finance the music creation, if you wish. And I think the report does go into that, but I would say that in a sense, along with the changes we've seen in the whole environment, that has motivated this additional this asset-backed finance, I think there are broader changes, that do change the incentives to create music, and I think that's something that I would encourage everyone also to read the report. We're a bit over time. There was a question about, phase 2, and I will sit down with Alexander and, we see how we essentially take it from here. And I can certainly sense that there's a lot of interest and demand, so we'll reflect on that. But again, let me just end by thanking again all the authors for their work. I think this was a really worthwhile exercise, and we are very happy with the findings that you presented.
Thank you so much, Karsten. I will also thank the authors and the discussants and the audience. CEPR has confirmed that by the end of this week, this webinar will be available online in case you want to watch it again or you want to send it some of your friends and colleagues, because it was really a very interesting discussion. So thank you very much to CEPR and to WIPO for hosting us, and goodbye.